Hi guys, welcome to my YouTube channel. So before we get started, make sure to hit the like button, also subscribe to my channel. In this video, we will talk about how to invest in stocks, 7 best ways for beginners to get started. So make sure to watch the full video. 1. Define your goals as a stock investor. Before investing a single penny, and even before opening a brokerage account, aspiring investors must first determine their own goals. Definitive goals may simultaneously give investors direction and set the bar for what they deem to be a success. Without a goal in place, investors will have nothing to compare their progress to, making improving all the more difficult. Additionally, specific goals will help investors determine their own investing approach, of which there are many. To be clear, making money is not a good goal for new investors to set. Simply deciding to make money is too broad of a statement. Instead, investors will need to formulate their own goals based on 2 fundamental concepts: how they want to make money and how long the investing window will be open. These 2 factors will prove instrumental in setting purposeful goals. The first thing investors need to do is establish a timetable. The length someone intends to invest for will dictate a lot of their strategies moving forward. If, for example, the new investor is in their 20s, their portfolio may be exposed to slightly riskier stocks with more growth potential. Younger investors typically won't need access to the capital in their portfolio anytime soon, and they'll have more time to course correct in the event of a market crash or poor investment decision. Investors on the brink of retirement will most likely need to tap into their portfolio sooner rather than later and want to switch to an investment strategy that reduces their risk exposure. 2. Open an investment account. Once investors are fully aware of their intentions and how long they want to invest, they will need to open an investment account. Otherwise known as a brokerage account, investment accounts are the platforms that grant traders access to the stock market. Not all brokerages are created equal, so aspiring investors will want to research each option before settling on one. 3. Learn about stock mutual funds and individual stocks. There are several types of stocks investors may choose to invest in. Each of the companies listed on today's major indices, in fact, represents an individual stock that may be purchased. That said, investors don't have to invest in a single stock with each trade. Those intent on diversifying their portfolios and taking a more passive approach to investing may choose to invest in a mutual fund. Individual stocks aren't better or worse than mutual funds, but rather different. Each one awards investors with its own unique pros and cons. 4. Set your stock investment budget. Investing in stocks for beginners comes with an inherent risk. There isn't a single investment vehicle, for that matter, which isn't associated with at least some degree of risk. New investors can't simply put all of their money in the stock market, which leaves many new investors asking themselves the same question: how much should I invest in stocks for the first time? It is of the utmost importance new investors only invest with disposable income. Do not allocate capital that is necessary for everyday life into a brokerage account. Make sure you are only investing money you won't need anytime soon. 5. Focus on long-term growth. There are many strategies investors can use to invest in the stock market. Day traders, for example, buy and sell stocks based on volatility. They may buy and sell the same stock multiple times in a single day to take advantage of drops in prices. It is worth noting, however, that day trading is an advanced strategy and should be reserved for seasoned investors. Investing in stocks for beginners should emphasize long-term growth. That means buying shares and holding on to them for years, if not decades. To be clear, long-term growth is just as dependent on a long-term growth strategy as it is on an immediate strategy. The sooner investors start buying shares, the sooner a long-term strategy will be realized. More importantly, the sooner an investor starts, the longer their investment window will allow them to compound gains. Robert R. Johnson, professor of finance at Creighton University in Omaha, Nebraska, is convinced there's no better way to invest in retirement than the stock market, and no better time than now. 6. Create and manage your stock investment portfolio. Investing in stocks for beginners consists of a lot of research and due diligence. Potential returns, or even losses, are too large not to invest a great deal of time into education. Therefore, every step up to this point has played a pivotal role in preparing investors for the actual practice of investing. Consequently, only investors who have completed the previous steps should consider creating and managing positions in a stock investment portfolio. To create and manage a portfolio, investors will need to transfer funds into their brokerage account. Remember, only use disposable income that won't be needed for several years. Next, research stocks that suit your investment approach. There are many stocks on Wall Street, and not all of them are worth your time. So it's of the utmost importance to mind due diligence when researching stocks. Only once you are sure you have found a company you are comfortable holding for several years can I even recommend considering opening a position, buying at least one share. Investors tend to get out of the stock market what they put into it. Those who spend a great deal of time researching trends, earnings reports, and companies' performances will most likely have a better chance to beat the market. On the other hand, those who throw money into any stock without the slightest bit of research or conviction are simply gambling, not investing. 7. Diversify your stock investment portfolio. When starting out, it may be a better idea for investors to invest in several companies. The idea is to develop a diversified portfolio that has minimal risk exposure. Investors who buy a single stock, for example, will find that the success or failure of their entire portfolio is based on the performance of one company. If the company faces challenges, the investor's entire portfolio is at risk. Therefore, instead of investing in a single stock, it is almost always a better idea to buy several stocks. Ideally, investors will be able to build a portfolio of at least 20 or 30 companies, but there's no objective number that must be reached. Instead, it is important to know that the more stocks investors buy across different industries, the more diversified their portfolios will be. When all is said and done, it is important to own a wide variety of companies. Variety is one of the best ways to combat risk, and there's really no reason not to practice diversification. However, the number of stocks you own will only diversify your portfolio as much as you have allocated capital between them. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.